Okay, we're still going to go, we're probably not going to get as far as I want to get tonight, but maybe we'll be much more. It's okay. I'm going to give out these little spreadsheets. It's actually, these are not production level spreadsheets, and we'll use them and change them. It's about trying to get initial, what we're trying to get here is to the initial set of expectations. We're trying to come up with what we think we're going to do. Get there. We still have to come up with actually what we're going to do. But the first step of your plan is coming up with your expectation of what you want your business to be. This is about expectation. It's not about getting lost in pure reality. You make a good guess. And then you make a guess on the pieces, and we'll put the pieces in, and we'll see how they fit, and we'll come back and we'll change them. Make some readjustments. That's how it works. You can't start at one place and go from one end to the other and get it right. If you do, you're just lucky. And lucky's good. Okay, so we allocated money to places where we might spend it. The next thing is we ought to talk about our manufacturing lines. So what we're talking about here is how many different types of trades do we want to be doing? Now, I'm going to pose to you, I'm going to actually suggest that we do no more than 4, and probably less than 4. If we do 1, we do not need a hedging strategy, an independent portfolio hedging. And we'll run this plan the entire year, or we'll change it. But we won't change plans. We'll run, whatever we do, we'll run quarterly. And we'll change it at a quarterly meeting if we actually want to make a major change. So I would pose that we do probably two forms of trading. And if you do 2 forms of trading, then we have to have a third, which is a portfolio hedging plan. So we end up with 3. And we could have 4, but I'm just saying, let's do 3. So what I kind of set out here, and by no means do I expect this to be, is that readable? A little higher? I worked at this at home. I took a projector home to try to do this so that we can try to make it visible.
Well, it's a good font size.
Okay. What I want to do is suggest that we do not start any one of our strategies with the full allocation of money that we have. We haven't allocated money to any given strategy yet, but that we ramp it up over 3 months. And the reason that I suggest that you ramp up as opposed to starting fully funded, because you never know when you're going to have the bad money. So you don't really want to start any of your trading with fully funded into the strategy, assuming that we have enough money to have more than 1 contract. So you don't want to start at all and have the bad month the first month, because you never know when that's going to occur. So you kind of phase into it so that you can gain a little capital and buffer when that first pullback comes, because it will happen somewhere along the line. So the other thing I'm proposing is we don't actually have a manufacturing plan. What we're doing now is we're making a guess at what we want this thing to do. So this is kind of high-level, arm-waving, holding one end and probably bouncing on the other leg, and trying to figure out how long we can stand up doing that and twisting around, which in our case may not last long. In my case, it wouldn't. Okay, so the very first little thing you want to think about is how many of these, so what I did is I just said, we'll start these at quarter 1, 2, 3, and quarter 2. I made random things saying, well, maybe we have an income stream going on. Maybe we have a speculative stream going on. We have something other that I didn't anticipate, because I think we're better off thinking about 2, because it's easier for us to manage. And then we have a hedging strategy. But we don't launch the hedging strategy until you have two manufacturing lines running. So, is that what you want to do? Or do you want to do something different? So a very quick choice. You want to go the way that I made up with basically 3 lines over time.
Sure.
Yes.
Or you want 4, or you want to start them all at once. I mean, it's your plan. I just merely, I didn't want to start this with absolute build it from scratch. I wanted to give you something. I threw numbers in. Do not get confused by the numbers. We're going to rework the numbers. It's just that it's more interesting if you got some number in there, and then we can adjust it. So I made a stat of 8 a while plan. You've already changed it. My plan's already failed now. I don't know what to say about that.
Jim, wouldn't launching one strategy in a quarter be enough to keep a person very, very busy?
Yes.
So why not stagger it so that you...
I haven't staggered.
Oh, do you? Okay.
Here's the starting, this point here.
Okay.
Q1 is tonight. It's either starts tonight or starts next night. Q2 would be when the second line would start. I didn't launch Q3 in my little scenario here, but I would say if we did a third one, we wouldn't bring that in until third quarter. That's what I had kind of in the big outline when I said the big vision as we launch these over time, because we'll learn these. We don't even have to launch a second one. I mean, there's nothing that says we have to do that. And Q3 is the hedge. So you don't have to hedge a single strategy, because you can hedge that in the strategy itself. You don't need a third trade to do a hedge, a portfolio type hedge. That's the only reason I did it that way. And I spent all the money. I just didn't launch. I allocated all the money up front. I just don't launch them at the same time. So we don't even have to spend all the money. This gets back, this is part of our money management scheme. So here's what I've got. Right here is, this number comes from the percent funding. Up here on, where we have 75% of our funding goes to trading. So if we chose 60% of that 22,000, that turns out to be 13.5. That's how that number's calculated. So it doesn't have to be that we do 100% of this funding. It just doesn't have to be. I just did it that way to put a number in. The next thing is how much risk. I mean, you can have a trade on, that does not mean that the money in that trade is at risk. We all know that. We talked about that last month. So you decide how much of that particular trade you're going to do. We're talking about the type of trade that we're thinking about. What kind of risk reward do we want with that particular strategy? How often do we think we're going to be successful with it? It's a pretty simple model. What we're trying to do is to come up with a single number, which I'll show you in a second. So we're not going to be 100% successful on all the trades that we do with that. Based on a basically year type number. And we can decide if we're going to take all the profit or if we take profit early, like 70, 80%. You know, you can say that I've got a trade that has a potential of risk $1 to make $1, but I can take it off at 80 or 90% and improve my probability of success. Or take 100%. So if you take those factors and you put those together, you can estimate a return per trade. This is very close to Van Thorpe's R number. It's based on this kind of analysis. So this is the number that's important to us, is we're making a guess that for every dollar that we, in this particular one that I made up here, going across this line, that for every dollar we get back 47 cents on the average. That doesn't mean that not all the trades are successful, but it gives you an estimation number. You can use the estimation number to estimate if you ran this for 12 months, this kind of strategy, what would it return you? That gives you this other little number over here, which gives you how much, you get a monthly profit that you expect to make on that. So that gives you a revenue type of flow. You throw that in, we'll go into the report analysis. That's where we're going to use that number a little bit later. So I'm not suggesting that these are good numbers. I'm just suggesting they're numbers. I'm telling you how the equation comes. And we're going to roll that in and show what that does in the profit. So we're going to have to be aggressive and quick on this, but yes?
Way back when you started putting in your assumptions about, or your targets, and we were discussing 25% or whatever it was, well, that goes way above 25%.
So we're talking, on 25%, we're talking about on our total portfolio.
Yeah.
And yes, it does. But I said at least. The words I actually used on that were at least 25%. I'm not saying that, these are not good numbers.
This is 300%.
Piece on that. And what we're now going to do is, what do you think we want to do? And then we're going to look over, when we look at our total P&L, or our balance sheet, and we're going to see how what these numbers work. We're going to make these numbers up. We're not going to use the numbers that I have on here. So, the steps are, very quickly, if you have an income and a speculation strategy, which one would you launch first?
Depends. What do you call speculation?
Directional.
Vertical?
Directional is speculation.
Believe me, so is non-directional.
Well, income is typically non-directional. You can change these names. Let's not get bogged down into that, because you'll burn a lot of time rather foolishly. But an income strategy, I'm thinking, to me, that's a calendar, that's a condor, or typical income type strategies. They're pretty simple. They're doing. If you're talking speculation, we're probably talking, you're expecting a movement you expect to be right. It's a directional trade, because you think you know how that's going to work. We're talking trades that last a month, because we can fundamentally need to work this in a cycle so that we can visit it once a month with a reasonable regularity, and you don't have somebody doing a whole lot of trading outside. So these are pretty simple trades. We're going to have to decide what these trades are. We're just, right now, you're making a guess at some kind of something you're going to do. So, if you were going to do income and speculation, Rob, what names do you want to use? I don't really care. It's not important what these names are. You're making a guess of what it does. So we can call this gummy bears and Dick Newtons. It has the same value. We're just going to make up a guess at what they're supposed to do.
So we should risk 1% per trade.
On what? How much funding are you going to put? The first question is, how much, we're going to have 2 streams, okay? So how much funding are you going to put in each one of those streams? Are you going to spend going to put all your money out there or not?
Yeah, 10%.
Well, it doesn't matter. I mean, you've decided. That's okay.
No, these are not good numbers. I can tell you they will not give you reasonable results.
Can you put something in that will?
No, that's my guess. This is your plan. So, make a guess. Do you want to spend 100% of your funding, or do you want to hold some back? Well, we're going to ramp up, so I mean, but we're talking big aggregation here. So would you put,
Well, what does ramp up mean to you?
you're going to start with 1/3 the first month,
Okay,
2/3 the second month, 3/3 the third month, and all future months,
all right.
unless you change it.
What about reinvestment?
We can do that. When you got more money, you can spend more money. We're going to start with a pretty simple plan when we work this over the next month. But we've got to get to the point of being able to make a guess of what do we want this first line to do. How much return do you want to get off of an income strategy or the gummy bear strategy?
Yeah, initially, that's my point. Initially, we said we were only gonna go for like 25% for the year. So that's why this doesn't make
Like
sense.
2% a month.
Look, let me fix this for you. Okay.
Okay.
And so you tell me.
I mean, these are goals, right?
These are what you're building your expectations. So you're building a strategy, something here that comes with that. What I'm going to show you then is what does that mean when you put that all together and roll that out as a plan. We're just making a guess of what do we expect that this is supposed to do. You want is this the kind of thing that you want?
Max risk 10%.
Well, you tell me. Don't question me whether it's right or wrong. Just tell me what the answer is.
Okay, let me propose something. I want to ensure myself that I want to be in business for at least 1 year. If that's the case, I don't want to lose or spend or put at risk more than 1/4 of what's available. So I would start out and say the max funding is $7,500 per quarter, and that will give me at least enough to get me through 1 year to see whether or not I'm good enough to keep things going. So I would change your last thing on line 28.
Change this one.
I would put $7,500 for quarter one,
Okay,
two,
well,
three.
$7,500 is what,
25%.
That's 25%.
Your capital's 22.5.
No, your capital's 22.
so,
So we have to divide that by 4.
Yeah, that's right.
And what's the,
look, 35%. It's
Okay,
close
but-
enough for government work.
Okay, yeah, that's close.
So how much of that, I mean, that's how much you're gonna put into the trade. That's either in margin or that's in purchase trade. How much are you willing, how much of that are you gonna risk?
No more than 2%.
right.
Well, 2% is, well,
Okay?
No, that's the risk.
Look, guys, you're getting the hang of it. I don't care what the numbers are. Okay? So your risk reward on this trade is what? You're gonna set this trade up at some risk reward level. That has nothing to do with your 2%. The risk reward, because you may take a lot more risk in setting the trade up in terms of its potential, but you're going to exit because of your plan, so you don't lose more than 2% on the trade. Now, so what kind of risk reward characteristics do you plan on setting up, Rob? You got your 2% there.
1-to-1.
What?
I think 1-to-1.
1-to-1? Okay, we won't go 1-to-1, we'll do. We'll make it just a little less than 1-to-1. You've got a better chance of winning that. 0.9. Because typically if you set that counter up to do 1-to-1, you typically lose that one. But if you get about a little better than that, you've got a better chance of winning. So how many of those trades do you expect to win?
How
Per
many
year.
are you gonna do?
You're going to do one every month.
Oh, okay.
I mean, you're going to start.
That's
You're
okay.
going to do one every month.
I just didn't understand. Okay.
So you expect to win them all?
No,
Get all? How many of them?
60%. 70%?
We're talking about, you choose a number between 1 and 12.
4.
So 60% is probably 7.
Yeah, 7.
Yeah.
Yeah.
Okay, that's fine. You're going to always going to go for max profit, or you're going to try to get out of the profit a little bit sooner?
Yeah, 80% is good.
8%?
80%.
Okay. That gives you an expectation of about 0.42 per trade. For an estimation person. Okay, for your speculation strategy, how much money are you going to put in that one? Put the same amount in that one as you would in the other one? Less? I hear 25 once. These numbers don't, we just got to get something in here, guys. That less? Okay. Okay, so, yeah, give me a number.
2%.
2%? Rob, you're not going to make any money. That's fine, it's fine. The risk reward on that, what kind of risk reward on that? That's a more directional, is it 3-to-1 or is that
2-to-1.
10-to-1 or
2-to-1.
2-to-1? You're not making any money. How many times is that trade going to work for you out of the year? How many? 5? Okay, you got to get the full double every time?
80%.
80%?
Yeah.
Okay, that gives you an expectation of about 0.67.
That's better than the first one.
the first one's a more conservative trade. Your probability of success is higher. Now, you're talking about trade, but we're going to go look at the money. Okay, how much are you willing to invest in your hedge? Your hedge, assuming your hedge never works, you're just going to spend money here, but it'll kick in when you protect. You know, the market goes against you. You only need to do this as a portfolio hedge. So how much of your allocation would you like to spend on that? 20% is way too high.
1%.
Marianne?
1%.
Okay. I think that you risk all of that. There's no question about that one. You expect to lose that. I think you ought to have probably a 10-to-1 risk-reward ratio on that. I mean, this is really disaster hedging. You're going to lose this money, but you're putting it in there to protect a sudden death. We can work on that. So we're not going to win any of those. That's our expectation, is not to win any, because we want all the other trades to work. Remember, if this trade works, the other ones probably fail.
Right.
So, profit percentage, yeah, we'll take 80% if we actually make a profit on it. So, our expectation of return on that is 0, because we're basically an expense. Okay, we have a guess now at kind of what we think we'd like to see those strategies work. We still have to build strategies that would do that.